Time for the word on Wall Street. Top investors watching your money this morning. Joining me, Verdence Capital Advisors CEO Leo Kelly. He's with us all morning long. And Brig McAdam Limited founder Greg Swenson and Fitzgerald Group principal Keith Fitzgerald. Keith, let me start with you. Netflix down in pre-market trading. It's off by more than 27%. It had already lost more than 40% of its value just year to date. Your reaction to Netflix report after the bell yesterday?
Well, I tell you what, the only thing, Dagan, that is surprising that it took this long for the rubber to meet the road. I've been screaming about this stock till I'm blue in the face. They've got a sharing problem, they've got a competition problem, and they've got a CEO who isn't acknowledging either, or hasn't until yesterday when the numbers were absolutely unavoidable. So the decision investors have got to make today is they got caught yet again with a Wall Street darling. Wall Street's going to put up some defense. There's going to be a lot of bottom fishing, but I'm not buying.
I was going to just point out, so Netflix sees a loss of 2 million paid subscribers in the current quarter. The expectation was for a gain of almost 2.7 million subscribers. If you look at the first half of the year, just the first half, Netflix will have 7.8 million fewer subscribers than Wall Street was expecting. So almost 8 million. The stock was already tumbling, and then Netflix tries to raise prices, Keith, in the middle of like the biggest inflation panic that we've seen in 40 years. And then they have the audacity to blame password sharing on a lot of the subscriber problems. At what price does this stock become a buy?
I don't think it does, Dagan. I think it's going to go from Wall Street darling to hero to zero very quickly because the competition's coming strong. They've got lots of other things in the brand stable. For example, with Disney or with Apple, they've got lots of other things that can move the needle. So a one-trick pony like Netflix has got a serious problem. They're talking about advertising, for crying out loud. That's why many people who watch Netflix left cable television in the first place. If we get that, my family's gone in a heartbeat, just like millions of other people are.
Amen to that. Leo, let me move on to the Atlanta and Chicago Fed presidents speaking yesterday, both saying raising interest rates will not cause a recession. We're also going to hear from Fed Chair Jay Powell at a meeting tomorrow. It's an IMF debate on the global economy. How can these Fed presidents say that? Are you predicting a recession?
Well, they seem to be able to say anything. If you remember back 18 months ago when inflation really started to kick into gear, they said, there's really no inflation, don't worry. And then when the numbers started to pick up, they said, this is transitory and will go away. And they have jawboned against inflation, and now it is until we see 7-8% that they really acknowledge that inflation's here and it's going to stay. Well, thank you. I'm glad you're on top of that. So, yes, the Fed has to come out and say, hey, we're going to make these moves. What they can't say is we're way behind the curve. We missed our opportunity, and now we're going to be aggressive, and that's a recession risk. So I think the Fed has to say that. And with regard to recession, clearly the risks are rising. And it's not just interest rates. It's input costs across the economy, whether it's energy, commodities, labor. Input costs rise. That lowers your return on invested capital, and that brings in recession risk.
Greg, given this backdrop of where the purchasing power of Americans is already being damaged by the high inflation, real wages or inflation-adjusted wages are falling more than 2.5% in the last year. People have spent down their savings. They're taking on more debt to cope with the high inflation at the same time that interest rates are going up, which will put an even greater burden on consumers. That looks like recession to many. So where do you invest given this environment?
Yeah, I agree. And I think inflation's going to get worse before it gets better. And if anything, to your earlier question, if the Fed does not hike enough to address inflation, rates are still negative real rates, then they're not doing enough. So either way, it's going to be ugly, I think. So yes, you have to be in defensive assets, real assets, whether it's private equity funds that focus on real assets, private credit, and specifically infrastructure, especially around sectors like food security and energy security. Those have been great opportunities for the last year and a half, they've only been elevated as issues because of the Russia-Ukraine situation. But, those are defensive, but also inflation protected. If you're in energy and food security, as well as, that are commodity based, you raise prices based on inflation. And those are assets I think you need to be in to still be long real assets, but also be in an inflation protected situation.
What about energy?
Yeah, I still like energy. I mean, there's risks because, energy, oil's traded up. There's always this risk that oil goes down. So I don't know that I'd be just going long oil or nat gas. But if you're in the integrated, fully vertically integrated energy companies, the majors, they could take advantage of lower prices. They're also leveraged to higher prices. So I like energy. I especially like energy infrastructure. Look, what's elevated as an issue because of what we've learned about the German dependence on Russian oil, for example, that's elevated the issue of LNG infrastructure, for example. And that's, again, inflation-protected assets that you can either invest as an equity investor or as a lender. And then look at food security. Africa's importing 85% of their food from elsewhere, and 30% of the world's, on the other hand, 30% of the world's grain comes from Russia and Ukraine combined. So you've got real issues here, but real opportunities as well.
Thank you so much, Greg Swinson, and also Keith Fitzgerald. Gentlemen, great to see you. Leo Kelly, you're with us all morning long. You sit right there. Much more ahead this morning. Coming up.